Now, come on, this is a broken market. This is complete nonsense. This is going to snap.
Is this worse than what we saw in 1929 or in even the tech bubble in 2000? Is this worse?
It's far worse than the situation that led to the inflationary 1970s. And I think that the next crisis will be considerably worse than the one we saw last time. They've just kept themselves going through debasing the currency.
Do you think that governments have already completely lost it, and that everything is just hanging by a thread right now, waiting to collapse?
They lost it a long time ago. And the one thing they've been very good at is actually taxing us through the printing of money to try and save their own skins. And I mean, this is what happened after Lehman. The blank checks, which the Fed in effect wrote, I reckoned at the time totaled about $13 trillion. Now, that was an enormous sum. I mean, it was considerably more than the whole of the US GDP. Now, of course, I mean, we think trillion here, trillion there. I mean, it's small money. Why? Because there's just so much of this currency and credit around that, a trillion, let's talk tens of trillions. Why bother with the smaller numbers? I mean, the debasement of the currency has been that dramatic, and they've just kept themselves going through debasing the currency. And it's been like that. I mean, the fascinating thing, we had an interesting program on art on the BBC the other day, and they were talking about art which had been given to the City Corporation of Glasgow. And there's one painting, I can't remember quite who it was by, but it was something like a Botticelli or a Titian or something like that, which the donor had bought for £4. Now that's 4 sovereigns, 4 golden sovereigns. You sort of think, what would it be today? I mean, that painting will be worth 10 million in auction today. Okay, now it's gone up. It will have gone up on its own accord, but a lot of that is debasement of the currency. And that's what's happened. It's been pretty much a continual process, certainly since Nixon ended the Bretton Woods Agreement in 1971. And I would say also certainly going all the way back to when Roosevelt devalued. Well, first of all, he banned ownership of gold for American citizens, and then he devalued the dollar by around about 40%. Sort of overnight in January 1934. Now, this, it's really from that moment that you've just got an explosion of government financing by debasing the currency. It started under the gold standard, and when that failed in various stages, it just went pure fiat. And that's what we've got now. And that's why gold, incidentally, has gone from at the beginning of this millennium, 21, 22 years ago, from $260 to, and I'm looking at my screen at the moment, 1835. That's why. It's not that gold has gone up. This paper money has gone down. It's gone down because governments just spend it like drunken sailors by expanding the quantity. I mean, if you've got a printing press and you can just print the money off it, then wow, what a wonderful thing to do. I'd be doing that all the time, kidding everybody who's got the money that, don't worry, it's perfectly all right. I'm looking after you. Mm-hmm. I'm debauching your currency and looking after you. Now, how about that for a line? That's what governments are effectively doing to us.
It's true. And it's one of the most beautiful ways to sort of describe currency debasement is to talk about why the UK's currency is even called a pound. I believe it was something among the lines of, maybe it can be, you're most likely definitely actually better than me at explaining this, but if I'm getting this correctly, a pound they called it that way because it used to be equal to a pound of silver, something among those lines. Yeah.
That's correct? Yeah.
Okay. So, and then you ask yourself, how many of those pounds right now do you need to buy an actual pound of silver? And there you have a very beautiful description of what currency devaluation looks like.
Yeah. Well, I think the better way to look at it actually is not that, because what happened was that after the sort of more or less after the Napoleonic Wars, we went on to a proper gold standard. And the sovereign coin, which was £1, which was £1 in currency, as it were, the equivalent of, it was fixed at that. That was first issued in 1817. Now, a sovereign today is £340 each. So you can see what's happened to it over all that time. Mm-hmm. The real decline was really following or during and following the First World War. And we went back onto a bullion standard, which basically meant that you could exchange pounds at the Bank of England for 400-ounce bars of gold. That was in 1925, and it failed in 1932. And since then, it's just continued to go downhill. And it's always, governments just cannot resist. I mean, if a government is in the business of interfering with our lives, then, they've got to finance it somehow. And there comes a point where, out of taxation, we start saying, no, well, I'm not going to elect you if you continue to tax me like that. So what do? They resort to the printing press. And this is where we are now. From £1 to 330, 340 pounds is what's happened to sovereigns. And it hasn't stopped there, in my view.
You see, this is where we are at right now. Does that mean that we are at the worst place that we've ever been? Like, is this what we're seeing right now, the everything bubble and everything combined, is this worse than what we saw in 1929 or in even the tech bubble in 2000? Is this worse?
Well, I mean, basically, it's worse when a crisis happens. In the crisis, that is when it's bad. And I think that the next crisis will be considerably worse than the one we saw last time, which was worse than the one before then. I mean, the whole global situation is just becoming destabilized. Let's put it this way. We now see that prices are beginning to rise. Why are they rising? Because the currencies have been debauched. It's actually as simple as that. But you won't find any central bank admitting to it. They say that prices are rising because of supply chain problems or imbalances in the economy. We expect it to be transient. And then that changes when that's so obviously wrong to, it's going to be a bit more persistent than we first thought. But I don't think, as a central banker, I don't think that this is going to be a long-term problem. So it will probably take a fairly small rise in interest rates to correct the situation. Well, apart from not understanding the role of interest rates, which is a separate subject, they seem to think that this inflation has got nothing to do with the fact that they've been debauching the currencies. In the case of the dollar, I mean, the acceleration in the increase in the quantity of money has been really quite remarkable. We've never seen anything like that in modern times, certainly. It's far worse than the situation that led to the inflationary 1970s. So what happens to interest rates? I mean, we've already seen the yield on the 10-year US Treasury move up to 1.9%, which surprised everybody. But I mean, didn't surprise me at all. In fact, what surprises me is where it is. I mean, the yield on that, I think, should be closer to 7%. Now, if I'm right, what will happen is that interest rates will rise further. And incidentally, the point about interest rates is that they're not the price of money. They reflect what the market expects it should be compensated for a combination of risk, not possessing the money, which is time preference, and also any changes in the purchasing power of that money. Now, clearly, the change in purchasing power at the moment so far has been recorded officially in America at around about, 7%? We're going roughly 7% now. And if you look at independent analysis of the CPI, like shadowstats.com, they see it at 15%. 15%. and a yield on US Treasury, the 10-year Treasury of 1.9%. Now, come on, this is a broken market. This is complete nonsense. Mm-hmm. This is going to snap. I think that what then happens is that as that snaps, you get a banking crisis. And the banking crisis will start, in my view, and we'll see whether I'm right, I think probably within just a month or two.
Oh, wow.
It will start exactly. It'll start in the Eurozone. Why? Because the Eurozone's had negative deposit rates. What that has meant is that Italian banks, Greek banks, Spanish banks, banks with bad and doubtful debts have been able to borrow money through the repo market from their own national central banks at 0% interest. 0% interest. The importance of this is that the collateral that they have used, their local regulators looked at it and said, okay, you reckon this is bad and doubtful debts, or non-performing loans, as they say in the jargon. I will say, as a regulator, that this is a performing loan so that you can use it as collateral in the repo market. Wow, wonderful. So I can get rid of this rubbish, chuck it off my balance sheet, give it to someone else in return for cash, for which I pay 0% interest. So what's happened? What's happened is that the repo market has grown in the Eurozone to well over 10 trillion euros. Now, just imagine what happens when interest rates go positive. Whoops, that starts unwinding. Mm-hmm. And as that starts unwinding, what's that? It is a contraction of bank credit. This is the typical banking crisis that happens every 10 years, give or take a year or two. The last one was in 2008. In the Eurozone, it was 2012. We're due another one. That is clearly the case. And I think that you will see these highly leveraged banks in the Eurozone being amongst the first to come unstuck. The other areas to watch are Japan, where again, the banks are similarly highly leveraged, but not quite as much as the Eurozone. The UK is not in a very good position. I mean, banks like Barclays have pretty high levels of asset to equity ratios. America, believe it or not, is actually at an average of about 11 times. I reckon is probably, sort of relatively speaking, in a pretty good place. But if you look back to the cycle of bank credit, which basically, when banks are sound, they're probably lending less than 8 times their equity out in the form of loans, if you like, appearing as assets on their balance sheet. 11 times is rich, very rich. And if you get, a collapse in the Eurozone, then, nobody's safe. Nobody is safe. I understand that, and I can't verify this, but I understand that banks are very wary in New York of lending to Eurozone counterparties. So, this could be something that's already beginning to start. I don't know. We'll see.
Okay, could you try and paint me a picture, though, on what the aftermath would look like? Like, what do rates look like? What does GDP look like? Where's real inflation? How is